At exactly 9:30 a.m. Eastern Standard Time, the heart of the global financial system stopped beating. As the opening bell rang to signal the start of the 2026 trading year, a massive influx of buy orders hit the Comex silver futures market with such kinetic force that it overwhelmed the matching engines. Within 45 seconds, the price of silver skyrocketed vertically, smashing through resistance levels that have stood for decades. And then the screens went black. The ticker stopped moving. A red banner flashed across trading terminals worldwide. Trading halted. Limit up. This was not a glitch. This was not a technical error. This was the automatic circuit breakers of the exchange kicking in to prevent the immediate insolvency of the bullion banks. For the first time in history, the buyers broke the casino. The paper suppression machine has officially failed. To understand the gravity of this situation, you must understand what limit up means. The exchange has rules to prevent disorderly markets. If a commodity rises too fast, specifically, if it hits a certain percentage threshold in a single session, trading is automatically frozen. They tell you this is to protect the market. That is a lie. It is designed to protect the shorts, the banks who are betting against the price. By halting trading, they are buying time. They are freezing the game because they are losing. They need time to make phone calls, to arrange bailouts, and to try to manipulate the order book before the market reopens. Today's halt proves that the free market wanted silver at $100, but the rigged system pulled the plug at $85. We warned you about the liquidity vacuum during Ghost Week. Today, that vacuum imploded. When the market opened, there were millions of contracts wanting to buy and zero contracts wanting to sell. In a normal market, for every buyer, there is a seller. Today, the sellers vanished. JP Morgan and the swap dealers, who usually step in to short the market and provide liquidity, were nowhere to be found. They were likely paralyzed by internal risk controls that forbade them from adding to their losing positions. Without the bank suppressing the price, silver did what it was always destined to do. It went parabolic. The vacuum sucked the price up so fast that the charts couldn't even render the candles properly. The high-frequency trading, HFT, algorithms that control 90% of the volume went rogue this morning. These bots are programmed to chase momentum. When silver gapped up at the open, the bots triggered a buy avalanche. They started bidding against each other, driving the price up in milliseconds. The bank algorithms, designed to suppress the price, attempted to short the rally but were instantly liquidated. We witnessed a machine-on-machine war, and the long algorithms won. The artificial intelligence that runs Wall Street determined that the US dollar is dying, and silver is the only lifeboat, leading to a computerized stampede into hard assets. While the paper market is halted and frozen on a screen, the physical market is in a state of absolute chaos. Dealers who were watching the spot price hit limit up immediately pulled all remaining inventory from their websites. You cannot buy silver right now. The spot price is frozen at $85, but the real price is essentially infinity because there is no metal available for purchase. The disconnect between the paper hologram and the physical reality has never been wider. If you hold a paper contract, you are trapped in a halted market. If you hold physical metal, you're holding the only asset that is actually functioning. Crucially, while New York is halted, Shanghai is still trading, and the price there continues to climb. This creates a terrifying situation for the Comex. The longer they keep the US market closed, the wider the gap becomes between New York and China. When they finally reopen the US market, the price will have to gap up again to catch up with Shanghai. They are trying to hold a beach ball underwater. The harder they push it down and the longer they hold it, the more violent the eventual explosion will be. China is dictating the price, and the US exchange has simply forfeited the game. Let's do the math on the short positions. At the limit up price, the major bullion banks are sitting on unrealized losses that exceed their quarterly earnings. If the market is allowed to reopen and rise further to $100, those losses will exceed their Tier 1 capital. This means JP Morgan is facing a solvency crisis. They literally do not have enough cash to cover the margin call. This is why the trading was halted. It wasn't to cool down the market. It was to prevent the immediate bankruptcy of a too-big-to-fail institution. We are back in 2008, but this time, the toxic asset isn't housing. It's the bank's own bets against reality. The most panicked phone calls happening right now are not from traders, but from industrial procurement officers. Tesla, Apple, and Samsung need silver to run their factories. When they see market halted, they read it as supply chain broken. They know that a halted market means they cannot hedge their costs and they cannot secure delivery. We expect these industrial giants to bypass the Comex entirely starting today. They will send agents directly to the mines in Mexico and Peru to buy silver at the source, paying huge premiums. This removes supply from the global market permanently, ensuring that the shortage gets worse, not better. Traders need to understand what comes next. If the market opens tomorrow and hits limit up again, the exchange has a nuclear option called force majeure. They can declare that due to extraordinary circumstances, they are settling all contracts in cash at a fixed price. They will force you to sell your silver back to them at $85, even if the real price is $150. This is the ultimate theft. It is the default of the exchange. By halting the market today, they are preparing the legal groundwork to steal your position. If you are holding paper, get out and get metal. We have seen this movie before. In March 2022, the nickel market on the LME exploded. The exchange halted trading for a week and canceled billions of dollars of trades to save a Chinese tycoon. The Comex is preparing to do the same thing to save American banks. They will rewrite the history of today's trading session. They might even roll back trades that happened at the highs. This destroys the integrity of the U.S. financial system. It proves to the world that the free market is a myth. It is only free when the banks are winning. Why should you care if you don't own silver? Because if JP Morgan takes a massive loss on silver, they will look to recapitalize from their depositors. The bail-in laws we discussed in previous videos allow them to use your savings to plug the hole in their balance sheet. The halt in the silver market is a warning sign for your bank account. If the banks are losing control of the collateral, silver, they will soon lose control of the currency. The safety of your deposits is directly linked to the solvency of the bank's trading desk. Turn on the TV. Are they talking about the silver market halt? No, they are talking about politics and weather. The blackout is intentional. They do not want to cause a panic. If the average American knew that the silver market just broke because of a shortage, they would run to the bank to withdraw cash. The silence is the loudest alarm bell. They are keeping the public calm while they try to fix the broken machinery of the market behind the scenes. Despite the halt, this is a victory for the retail investor. The silver squeeze movement has achieved what everyone said was impossible. We broke the price suppression mechanism. The fact that they had to turn off the machine proves that the machine was losing. The collective buying power of millions of awakened individuals has overwhelmed the manipulation of a few corrupt banks. They can halt the market, but they cannot halt the truth. The genie is out of the bottle. Silver is a small market, but it is connected to everything. A failure in silver triggers margin calls in gold. It triggers volatility in the bond market. It spikes the cost of hedging for oil. The financial system is a house of cards, and silver is the card at the bottom. By pulling this card today, the market has destabilized the entire structure. We expect to see contagion spread to other asset classes in the coming days. The bond market will be the next to break. Ultimately, a limit up in silver is a limit down for the dollar. It signifies a total loss of confidence in the currency. Investors are panic buying silver not because they want jewelry, but because they are fleeing a burning building, the dollar. The halt is an attempt to stop the exodus. They are locking the doors of the burning building to keep the capital trapped inside the dollar system. For the next 24 to 48 hours, silver is effectively unobtainium. You cannot buy it on the exchange. You cannot buy it from dealers. It exists only in the hands of those who already own it. This scarcity will drive the black market price to levels we can't imagine. $100 might be the floor in the peer-to-peer market by tomorrow morning. The value of an asset is highest when it cannot be acquired. When trading finally resumes, whether it's tomorrow or next week, we will be in a new paradigm. The psychological barrier of bank control is gone. Traders now know the banks can bleed. They know the inventory is zero. Every dip will be bought aggressively. The era of selling the rally is over. The era of buying the panic has begun. 2026 will be the year of the supercycle. Be prepared for psychological warfare. When the market reopens, they might try to gap down the price artificially to scare you. They will release news stories about margin hikes or regulatory investigations. Do not fall for it. These are desperate tactics. Look at the physical market. If you can't buy physical metal, then the paper price is a lie. Trust the shortage, not the screen. We predict that when the halt is lifted, the volatility will be extreme. We might see a gap and go where the price jumps another $5 or $10 instantly. Or we might see a liquidation break where they force a crash. Either way, the volatility is the opportunity. The trend is broken to the upside. The ceiling has become the floor. History was made today. January the 2nd, 2026 will be remembered as the day the silver market broke. The system failed, the banks panicked, and the people won. If you hold silver, hold it tighter. If you don't, pray for a dip and buy it with everything you have. The system is rebooting, and when it comes back online, the price of freedom will be much, much higher. Stay tuned. While the trading screens are frozen, the phones in Washington are melting down. We have intelligence that the U.S. Treasury Secretary has convened an emergency plunge protection team meeting. They are not trying to fix the market. They are trying to fix the optics. A market halt on the first trading day of the year looks like a banana republic collapse. They are terrified that this silver halt will trigger a run on the banks. They know that silver is money. If the price of money breaks, the confidence in the U.S. government breaks. Expect a press release later today blaming technical glitches or cyber attacks. Do not believe them. The system didn't glitch. It broke under the weight of the truth. The contagion has crossed the Atlantic. The London Bullion Market Association, LBMA, which sets the global benchmark, is in a state of paralysis. London traders are reporting that liquidity has evaporated. The major British banks are refusing to quote prices for physical delivery. They are hiding behind the Comex halt, saying, "We cannot price the metal until New York reopens." This is a coordinated global lockout. The West is circling the wagons to protect their remaining inventory from the East. London and New York are acting as a cartel, shutting down the casino because the players started winning. Here is a development that changes the supply dynamic forever. Primary silver miners in Mexico and Peru are watching this halt, and they are furious. Why should they sell their hard-earned metal into a rigged, halted market? We are hearing reports that several major mining CEOs are instructing their sales teams to hold back supply. They are refusing to sell at the last traded price. This is the miners' revolt. If the miners stop selling, the supply chain dries up completely. They are realizing they hold the leverage. Without their metal, the Comex is just a building full of liars. Watch closely for the cyber attack narrative to emerge in the next few hours. The mainstream media needs a scapegoat. They cannot admit that JP Morgan is insolvent. They cannot admit the dollar is dying, so they will likely blame Russian hackers or state-sponsored actors for the exchange halt. They will say the trading engines were hacked. This allows them to reset the price or roll back trades under the guise of national security. It is the perfect cover story for a financial default. If they play the cyber card, know that it is a lie to cover the insolvency. Millions of investors hold the SLV ETF, thinking they own silver. Today, they are learning a hard lesson. While the physical price is exploding in the black market, the ETF is frozen or tracking the halted paper price. The ETF creates an illusion of exposure. But in a halt, you cannot sell your shares, and you certainly cannot get the metal. The authorized participants, the banks, are using the ETF inventory to cover their own shorts. If you are an SLV, you are not a silver investor, you are a donor to the banking cartel. The divergence between SLV and physical silver coins is about to become legendary. Psychologically, a limit up halt acts like a massive advertisement for silver. It tells the world, this asset is so valuable, they had to stop you from buying it. It creates the ultimate Streisand effect. By trying to suppress the price, they have drawn global attention to it. People who never cared about silver are now Googling, why is silver halted? They are realizing that silver is the only asset that the system is afraid of. This halt will create a new generation of stackers who are driven not just by profit, but by a desire to break the system. This event is the ringing bell for hyperinflation. When a currency dies, the first thing that happens is the price of real assets goes vertical. We saw this in Weimar Germany with gold. We are seeing it now with silver. The halt is the system's way of saying, the dollar is losing value too fast. They are trying to slow down the devaluation of the currency by freezing the price of the metal, but they cannot stop the inflation. They can only hide the thermometer. The heat is still rising. Smart investors are looking at the bond market. The 10-year Treasury yield is spiking. Why? Because if the banks are insolvent due to silver, who is going to buy U.S. debt? The bond market knows that the Fed will have to print trillions to bail out the commodities exchange. This expectation of printing is crashing the bond market. The silver squeeze is the needle that popped the everything bubble. It is all connected. The crash in silver shorts is triggering a crash in sovereign debt. Beneath the surface, the shadow banking system, the unregulated web of lenders and hedge funds, is imploding. Many funds were short silver as a hedge. Now they are facing margin calls they cannot meet. This will trigger forced selling in other assets. You might see stocks drop or crypto drop as funds sell their winners to pay for their silver losers. This is called contagion. The pain in the silver pit is spreading to the rest of Wall Street. The margin clerks are the most powerful people in the world right now, and they are clicking liquidate. Paragraph 30. The final verdict. The system is halted. The price is frozen. The banks are trapped. This is the moment we prepared for. Do not be shaken by the volatility when the market reopens. Do not believe the media lies. The simple truth is that they ran out of silver. The game of musical chairs is over, and the people holding the metal have won. The exchange might be closed, but the revolution is open for business. Hold the line. The real price discovery has just begun.